be able to spot a trend's exhaustion, we look for three significant technical conditions. The first is looking for a trend line break or a moving average break. We can also look for divergences in your RSI, and we can also look for potential reversal patterns, which doesn't happen all the time, but if it's there, it would help attempt to attest to the potential reversal condition points. The first particular point we're going to look at right now is a trend line break. Now, trend line break is simply a trend line that's drawn along with the current trend. If you're looking at the sample graph of Ayala Land that we have here right now, I will draw a downtrend line for you. And this took place sometime towards the end of 2016, going to 2017. And you can see that the price had managed to be able to break above the trend line, downtrend line condition here. And that tells you that the downtrend that we've been observing has lost its steam, and that the ability for it to be able to turn upwards is now attempting to show. So this is an example of the first type of signal that we would trace out to be able to indicate a potential reversal condition. Okay, another tool that we can use aside from a trend line is to be able to use a moving average crossover or breakover. Now, moving averages are another way of trying to determine trend activity. Now, we draw moving average along a graph to be able to give us a good sense of how a price is actually falling very quickly or very slowly as against the average price in a particular condition. Now, the chart I have over here is a chart of MPI. I took the liberty of drawing a downtrend line here also towards the end of 2014. And if you notice that a trend line break did take place. Now, advances came right after that, but if you saw a more gradual type of approach had taken place. Now, eventually, you see prices are breaking over the first, second, third, and fourth moving average. And as it slowly attempts to be able to break above this, it gives you a sense of how strong the particular trend advance is actually moving on with. The more moving averages that prices break over, the more consistency and strength that you would see in the ability for a stock to continue moving up. So if this recovery only stopped at the first or second moving average, then it might take a longer time before the reversal prospect takes in hand. And that's why we'd like to see more moving average breaks along with the new trend to indicate much more firm strength and, of course, the more viable up move that you may have from this. Okay, in the moving averages that we have plotted, we actually have four moving averages plotted here. The first one is a 20-day exponential moving average. The red one, the second one, is a 50-day. The blue one is a 100-day. And the last one that you see here is a 200-day exponential moving average. An exponential moving averages are actually used by more advanced traders instead of what is known as the normalized type of moving average, because this is more sensitive to the current activity of prices. The exponential moving average tends to move faster as the more recent development in prices actually taking place. So if you use a regular moving average, it might be just a little bit slower, but it pretty much can be substituted and it does the same effect in the end. Okay, so the third type of indication we'd like to see to indicate trend weakness is what we call divergence. Now, divergence requires the use of the RSI indicator. Now, we plot the RSI along with the price, and we tend to look at the tops and the bottoms of the graphs to be able to take a look at these types of indications. If you look at the graph that we have here of ICT, you will notice back in May, June, and July, earlier this year, you would notice a low that had taken place here in May and a lower low being shown in July. But if you were to look at the RSI indicator, which is presented here on the bottom, you will notice that instead of making a lower low, that the RSI made a higher low. Now, this diverges or goes against what happened initially on the top indicator of having lower lows. Now, the reason we spot this is because this tells us that despite the price moving into a lower low condition, the strength that pushed it down was actually weaker. And because of that weakness, it indicates the potential for a trend reversal to actually come in because the selling force is starting to abate. And this is a one way or more advanced way of trying to be able to detect a potential reversal condition even before it had taken place. And this is the reason why divergences are a sought after indication in terms of forming the precept that a potential reversal is about to take place. Notice what happens later on. After the divergence has been spotted, the recovery rally that you saw actually was more viable and took quite a long time to be able to present itself rather than being a short and stubby one. And this is the reason why, of course, divergences are also really very necessary in spotting this reversal condition. All right, so another manner of trying to be able to detect a potential reversal from a trend condition is to be able to look for what is called as a reversal pattern. Now, because it is a pattern, it is a consolidation that you will spot either in the absolute high or in the low point of a graph. And the indication of an area pattern will suggest that a counter force is coming in to try to be able to either accumulate or distribute the stock. In a downtrend, if you see an area pattern appear there, that means that there was a potential buyer that came into the picture that is now trying to accumulate shares and tighten that supply so they will to end the decline and attempt to force it back up. If you notice the example I have here of Globe Telecom, sometime towards the middle of this year, you again will see a downtrend line form here between the beginning of the year all the way up to about May. And prices ruptured that a little bit and built a little small pattern. I will indicate that pattern for you. So the pattern that you see here is called a falling wedge. Now, but this particular type of area pattern being framed near the previous low suggests that this pattern is coming as a retest of the support that it had generated. And eventually, after the pattern ended and a breakout took place on the upside, it told you that the ability for demand to come back in and push prices have actually been quite successful. The seller has now been taken out of hand, and there is no more limiting factor to be able to keep the stock from moving back upwards. And if you notice what happened right after that, a very sharp and durable advance was actually carried out in Globe. So spotting reversal patterns, especially after trend line breaks, is another way of trying to be able to reassert that sure enough levels of demand are coming back to be able to push the stock higher. You could also find different types of patterns here other than falling wedges. Rectangles are very common in bases, especially long ones, because sometimes it might take a few months to be able to form. You might also find some triangles also at about this area. Double bottoms are also very common during this particular type of trend reversal conditions as well. Now we talked about confirmation. Usually trend reversals will slowly give you signals that they are taking place. Now when a trend reversal comes in, trend lines are usually broken or moving averages are commonly broken. You might or may once in a while also have an area pattern build itself. But how do we know for sure that things are actually going up already after that particular reversal condition? Now we add a little bit more clues into the significance of this because we have to be able to make sure that this thing is really rendering into the upside. And we also want to be able to see if we can get what is known as support retests. Now to me, support retests are very important. I'd always like to say people stand on 2 feet. So do graphs have to do the same thing. So if you see that the price of a decline falls to the first low that it makes a recovery, and then falls back near that low, even if it's slightly lower, and recovers back. These are the 2 feet that the market needs to be able to tell you that it's going to stand quite strongly and then take a reversal. So these particular types of incidents are quite crucial in confirming that prices are indeed on the way up already and that you can attempt to be able to push more aggressiveness into your investments. Alright, this is quite essential that when you're learning how to be able to trade these particular reversal conditions, that you have to understand that you are going against a trend, at least initially. Sometimes you may make a mistake. You might call it a little bit too early. Sometimes you might call it a little bit too late. And that's why trying to be able to get yourself in at the right conditions, given the right signals, becomes quite key in handling a reversal condition. Now, in conditions where you find yourself a little bit in hot water, because you've tried something a bit too soon and you find prices attempting to be able to head downwards, it's always very good for you to be able to make sure that you limit your amount of risk when you take it. Whenever I attempt to make a first purchase, I've always identified that if the price goes below a certain level, usually at an area of support, that I will cut my particular positions down to something more manageable or cut the entire loss out immediately. It's very much prudent that we have to do this, because if you're going through a decline and you called it a bit too soon, then you might find yourself continuing in a very, very wider decline. And that's why it's very important for you to be able to try this, with very much managed risk. So if you get your support cracks taking place, please exit your position. Now, when you come around to do this, it's okay for you to be wrong once in a while. You gotta practice this as often as you can. You'll get the hang of it in good time. And do understand that since we're taking these trends even at the complete start of a particular change in trend, it could be quite tricky. Do anticipate some choppiness with the price when this happens, but you have to be a bit more firm in your belief that this is taking place. You might want to be able to buy gradually into this as your confirmation stand becomes much more stronger. So if you're thinking of coming in really early, buy maybe 30% of your position first. As you start seeing that more confidence comes in because your moving averages are breaking or an area pattern is breaking out, then you can slowly add up to maybe another 30 or 40% into your position and build up along with your level of confidence. But try as much as possible to make your first purchase the biggest. And as you add on to a very sharper advance, that you probably would only be adding a little bit less and lighter. Always remember that since you're taking this completely from a reversal condition, that risk is very much at hand here. So always make sure that your protective stops are always put in place just to make sure that in case anything goes wrong, that you have the ability to manage that particular type of risk.